Everyone is looking to get some passive income in Singapore. That's why we have seen investors park their money into T-bills or high-yield savings accounts where interest rates were high, 3 to 4%. But now that interest rates have come down, many of us are looking at alternatives like dividend-focused ETFs. So today I'm going to show you how to pick the best dividend ETF in Singapore. Let's go! So Business Times just dropped an article highlighting the top 10 dividend-paying ETFs on SGX. While the title definitely caught my attention, a word of caution is that high yields doesn't always mean good investment. In fact, I recall that a few years back, I was looking at Eagle Hospitality Trust and still quite confident I found a cheap, undervalued REIT paying such a high distribution yield. I think it was 14 to 15% when I bought it. 1 year later, the share price dropped 100% because it literally went bankrupt and my dividends couldn't even cover my kopi money. That's when I realized chasing yields is like ordering the cheapest chicken rice. Sure, it's very cheap, but you might end up with just rice, no chicken. So instead of chasing dividend yields, let's just follow this simple 5-step framework that I want to share with you. Number 1. Sustainability of the dividends. We don't just want to go for like maybe 15%, 20% distribution yield. We should look beyond that. Check out for the dividend payout policy. What is their frequency? Is there stability? Or do they have dividend cuts in the past? Is it well supported by the earnings or the cash flow? Second one, quality of the underlying holdings or companies. Do you like the companies that are inside the ETF or inside this particular whatever fund that comprises of all these holdings? Are they financially sound, profitable, generating enough free cash flow for you to give out as dividends? So for example, another ETF popular in Singapore is the STI ETF. So they are comprising of banks, telcos, REITs and all that. So you know what is going into the ETF itself. Third step, look at the diversification and concentration risk. How many holdings are there in the ETF itself? And on top of that, look at the sectors they are in. You don't want to maybe just go for one that is entirely of hospitality ETF. And if another COVID incident happens again, the hospitality REIT will get hammered down way back. So a balanced spread will give you more resilience in terms of different market cycles as well. Number 4, look at the total return potential. Of course, dividends are very important, but price growth also matters as well. Check out the 3 to 5 year the track record versus the benchmarks. They can be the STI index or they can be the MSCI Asia index. Alright, compare and see how the ETF has performed in the past. Last but not least, look at the cost and accessibility. One thing to take note is the expense ratio. You want it to be as low as possible so that it can generate you better returns over the long term. Accessibility. Can you buy or invest in the ETF using only cash? You also do it by CPF or SRS. And to make it practical, right, I'm gonna use one example, which is the Lion-OCBC Securities Singapore Low Carbon ETF and apply each of the steps to this ETF so you can see how it works. Let's dive in. To analyzing any ETF or fund is of course to go to the website. So in this case, Lion Global, which is under OCBC, is the ETF issuer. So you can actually come to the website and open up all the documents, right? Be it the fact sheet, prospectus, their latest newsletter and things like that. Let's go back to the 5-step framework. The number 1 thing is to look at the dividend yield. So I actually came to the SGX website and saw that the ETF Lion Global Low Carbon ETF is paying out 5.9% dividend yield. It is in fact the highest among all the sustainability linked ETFs listed in Singapore. Alright, and if I were to check this newsletter, okay, they are also rebalanced semi-annually. So they pay out the dividends on a semi-annual basis. And in fact, on the last year, 2024, they announced a special distribution of 3 cents per unit to help investors lock in the capital gains on top of the semi-annual distributions. So this is a good thing to have. The second thing is, of course, to look at their holdings. And for that, I actually opened up their fact sheet as of September 2024. And you can see that it is not your typical REIT ETF. In fact, they have C Limited comprising of 7.8% of the entire low carbon ETF. We have the banks, we have this Flux Limited, Grab Holdings, SGX and all that. So in fact, when we're talking about the capital growth part, which is the total potential returns, right? A big part of their growth is actually driven by companies like Yang Keppel, C Limited and all that. So in a way, we are not looking at just the 5.9% dividend yield. But on top of that, because they have all these high growth companies that are giving out, that are also part of this ESG investing methodology, mandate that they are part of this ETF, and as a result, they are also able to drive the capital growth as well. Back to the ETF newsletter, you can also check out this sector breakdown, which is quite nicely done. You can see that it's quite well diversified. You have telecommunications like Singtel, you have banks from the financial sector, you even have technology sector like Grab and C Limited. So overall, quite well balanced. And talking about the last step, which is the cost and accessibility. Over here, you can see that they are charging a management fee of 0.4% per annum, which I feel that is quite manageable, it's quite low if you look at their annualized percentage returns since the fund's inception. So you can see this asterisk is talking about how the ETF was listed on April 2022. So it's been 3 years since then and they are giving out a 11% annualized returns. What is 0.4% cost as compared to a 11% annualized returns? And overall, in a nutshell, I feel that this low carbon ETF has fulfilled the 5-step framework that I've highlighted in the beginning. Enjoying the breakdown thus far? Appreciate it if you can help me to smash the like button and hit subscribe. Also, join 9,000 plus investors in my free weekly newsletter at investkaki.com, where I share market insights, stock ideas, and investing lessons every single week. Now, many of you may be asking, what about REIT ETFs? They are the traditional dividend go-to in Singapore. But yes, I have actually done a full breakdown in the past video over here. So today, I actually wanted to highlight another option, which is the Lion-OCBC Low Carbon ETF. Actually, there are also 3 other reasons why this ETF stands out. So first of all, if you have already checked out my previous 5-step framework, it is the idea of broader diversification. So REIT ETFs are great, but they are heavily tied to properties. This low carbon ETF gives a wider spread. You have stocks, you have banks, you have industrials, consumer names, and also REITs. So I'm not just relying on one single sector to drive the returns. Second one, future ready theme. So this low carbon is a long-term trend, right? The shift towards lower carbon, ESG investing, more sustainable companies. So I'm investing in companies that are aligned with where the world is heading to. Last but not least, I like this ETF because it's not just about chasing yield, it also go for capital growth potential and dividend income as a bonus. So REIT ETFs are usually leaning more towards distribution yield, but this one give like at least 11% returns, which actually may be even more than a lot of what dividend focused ETFs can give. Okay, quick recap how to pick the best dividend ETF. Number 1, look for the sustainability of the distribution yields. Go for the dividend policy. Are they paying out semi-annual basis or are they having difficulty paying out in the past and things like that. Number 2, check the underlying holdings. For instance, the low carbon ETF is actually having C Limited and Grab Holdings as part of their holdings. So you should also understand the selection criteria. Number 3, ensure proper diversification. Even if you are investing in a REIT ETF, go for REITs that are spread out among different sectors. One may be the healthcare sector, the other one may be the REIT sector, and the other one may be in the data center industry. So you have to spread the risk across these different sectors. Number 4, go for the total returns. Don't just go for dividends. That may be just maybe 5 to 6%. If you get bonus, capital appreciation, you can maybe even push your returns up to 10% and more. And last but not least, watch out for the fees and liquidity, and also whether you can invest in this kind of ETFs using CPF or SRS. So there is another option for you to keep your costs low, or another way to invest in this kind of ETFs. And by applying this 5-step framework, you can build a portfolio that is steady, sustainable, and future ready. So at the end of the day, remember this: choose dividend paying ETFs that last over a long period of time, because dividends are nice, but it is the sustainable long-term returns that will keep your kopi money flowing year after year. And I would like to hear your thoughts. Would you invest in a low carbon ETF like this one, or stick with the high yield REIT ETFs? Drop your comment down below. If you have enjoyed this breakdown, don't forget to like my video, hit subscribe, and for more bite-sized insights, check out my free investing newsletter at investkhaki.com. I'll see you in the next video. Thanks for watching, and bye bye.